Is the market setting up for the next breakout, or is this just the calm before a bigger move? Today, we're seeing something very interesting. The 10-year Treasury yield is holding near 4.05%. SPY is stabilizing around 684. QQQ is hovering near 603. And here's the key question. If yields stay elevated but stocks refuse to break down, who's about to give up first? Let's break it down. The 10-year yield is sitting right around 4.05 to 4.06%, basically flat on the session. But this level matters. Over the past weeks, the 4.00 to 4.10 zone has acted as a psychological pivot. When yields spike toward 4.20, equities struggle. When yields drop toward 4.00, stocks breathe easier. Right now, we're in the middle. That tells us one thing. The bond market is not panicking, but it's not fully relaxed either. Traders are likely waiting for new macro data, inflation expectations, Fed commentary, or labor market signals. This kind of tight yield consolidation usually precedes a larger move, and when bonds move, equities react fast. SPY is trading around 684 after showing intraday volatility. We saw weakness earlier, followed by a bounce, and now we're stabilizing. That tells us buyers are stepping in, but not aggressively. Important level to watch. The 680 to 682 area has acted as short-term support. If that breaks decisively, we could see momentum accelerate to the downside. On the upside, reclaiming 686 to 688 with volume could trigger a push toward recent highs. But here's what stands out. Despite yields staying above 4%, the S&P isn't collapsing. That suggests positioning may already be cautious. There's no panic selling. It's more of a controlled environment, which often precedes either a squeeze higher or a sharp repricing lower. QQQ is around 603 after hours, slightly softer than earlier highs. Tech remains sensitive to yields. When the 10-year rises, growth stocks feel pressure first. Today, we saw gradual intraday weakness into the close. That's not a crash, but it shows hesitation. If yields push above 4.10 to 4.15%, QQQ could face renewed pressure. But if yields drift lower toward 4.00, tech could quickly regain momentum. This is why the bond market is the real driver right now. Not earnings, not headlines, rates. Here's what today really tells us. Markets are compressing. Volatility is shrinking. Yields are stabilizing. Equities are chopping sideways. This kind of environment builds tension. And tension usually resolves with expansion, either a breakout higher or a breakdown lower. The next catalyst could be inflation data, Fed comments, economic growth signals, or simply positioning unwind. Right now, we're in a waiting game, and waiting games don't last forever. So watch the 10-year yield closely. If it breaks above 4.10%, pressure builds on tech and growth. If it drops below 4.00%, equities could rally hard. The bond market is leading, equities are reacting, and the next move might be closer than it looks. See you in the next update.